Hey guys, Carl Allen. Welcome to Dealmaker Empire, Module 8, Lesson number 3, all about due diligence. So this is a pretty heavy lesson, but rest assured you are not doing this work. You might do some of the commercial due diligence, which we'll get into shortly, but it's all about the advisors in the deal team, your lawyer, your CPA, and potentially consultants. These are the people that are going to be doing most of the due diligence. Your job is to be the coach of the team. So there are 4 parts to due diligence. You've got financial due diligence, which is all about the numbers, the taxes, the margins, etc. You've got commercial due diligence, which looks at the marketplace, the customer base, competitive trends, threats, weaknesses, opportunities, and so on. 3, you've got legal due diligence to make sure that there's nothing wrong with the business and that the seller actually has full legal title to sell the business to you. Whether it's an asset sale or a share sale, it doesn't really matter. You still need legal due diligence. And then 4, if you're raising a financing for a closing payment, whether it's a bank, an asset-based lender, an SBA-backed loan, or an equity investor, you're going to have financier due diligence. So we'll go through that as well. And then I'll walk you through some of the changes that may need to happen to the deal structure once you've done all of the due diligence. Again, absolutely do not do the vast majority of this yourself. Your job is to be the coach of the team, but I'm walking you through all this stuff so that when your advisors talk to you about their process and the things that they're finding, you will be well versed in what everything means. So let's start with financial due diligence. So financial due diligence typically has 8 components, all about reporting. It includes due diligence on sales revenue, expenses, cash flow, the balance sheet, tax forecasting, and the accounting process and the controls. I'll walk you through what you need to do to negotiate a net current asset position for your letter of intent. And with respect to the reports, what you're really looking for are statutory accounts. So you want the formal accounts that have been compiled by the CPA or the accountant for the business. You don't just want spreadsheets or things written on bits of paper. Believe it or not, you will come across deals that don't have proper accounting processes, but you want the last 3 years of statutory accounts minimum. If there's been volatility in revenues and volatility in earnings, etc., you might want to go back even further. And depending on who you're talking to, some financiers may ask you for up to 5 years of accounting statements. You'll also want the monthly management accounts for at least the last 2 years, including the current year that you're in. So if it's July and the business's fiscal year end is, say, December, you'll want January through June of the current year, plus the whole monthly accounts for the previous 12 months. You want to see how the numbers trend over the course of the year to see whether the business has a high degree of seasonality. Because if a business has got a high degree of seasonality, it's going to have different cash flow requirements. Your financial controller or CPA can guide you through that, but that's why we need monthly data. You'll also want to see a reconciliation of management accounts to statutory accounts. For example, if you've got monthly numbers for 2019 as well as the full annual set of accounts, then the annual numbers should be prepared and filed statutory, and you want to make sure that they reconcile with the business's internal books. It sounds obvious, but I've lost count of the number of deals that I've looked at where those things do not tally. So you want to make sure that everything ties off, and your CPA is going to do that for you. Now, if the business you're buying is on the larger side, it might have board meetings. So your CPA might want to see copies of the board meetings minutes, since all of the action items that the business has gone through will be listed in those official records. It's great to go through those and see what the company's been doing for the past couple of years and if it's had any major issues or anything like that. And after reviewing the reports, your CPA will really go through the sales and revenue due diligence. They should look at what the mix of revenue streams are, meaning what came from products or from services, etc. And they'll want to get an understanding of the revenue generated per client. You want to see whether the business is diverse with a wide range of customers as well as products and services. Because if anything happens to those one or two clients or one or two products, the business is going to be in some trouble. You want diversification across the business, and you want to really see how these numbers trend on a month-by-month basis, not just annually. Next, as part of the sales due diligence, your CPA or accountant will look into what key performance indicators or KPIs the business is monitoring on a daily, weekly, monthly, or quarterly basis. So revenues, profit margins, cash flow, cash balance, marketing ROI, churn on inventory, days of sales outstanding for receivables, payables, all those different things. You want to see what those are and how they've been trending as well. And you want to see this data for the last 2 years minimum on a month-to-month basis to see if and where the business has had, say, spiking orders. If you're looking at a business that's been trending at $1 million a year for the past 3 years, and then all of a sudden it's doing 2 million, you really want to understand what caused that big one-off sell spike and if it's going to be repeatable. Because if it's not, you can't value the business on that increased spiked performance. You've got to look at the underlying performance of the business. And you'll also want to understand what the customer's payment and contract terms are, as well as any changes of contract clauses or control. And often with larger corporate customers, there could be clauses written into the contracts, making them null and void if the business changes hands. This happens with suppliers as well. You've got to go back and renegotiate the contract to continue doing business. So these are things that your advisors are going to spot for you. Your CPA or accountant will do the same level of analysis around expenses. There are two magic costs in a business. You've got the cost of sales, like the cost of raw materials, of labor, etc. And then you've got overhead or fixed costs, like rent, payroll taxes, utilities, admin costs, travel, R&D, all of those different things. So your CPA will really get a handle on what those expenses are, whether they've changed over time, whether they're above or below normal industry standards, etc. If you've got a business that has inventory, your CPA will do a pretty big deep dive on that, be it manufacturing, engineering, retail, whatever. Inventory can be classed in 3 different ways. First is called FIFO, F-I-F-O, which stands for first in, first out. Then you've got LIFO, L-I-F-O, for last in, first out. And then finally, AVCO, A-V-C-O, which stands for averaged cost method. So let's say you've got 1,000 widgets in your business and you sell one. With FIFO, you're using the oldest cost of the inventory as part of your cost of sales. With LIFO, last in, first out, if you ordered widgets a week ago, and then again 2 weeks ago, and you sell some of the widgets as part of the product. With LIFO, last in, first out, if you ordered widgets a year ago, and then you ordered some again 2 weeks ago, as you sell some of those widgets as part of a product, with LIFO, you're using the newest cost of the inventory, the stuff that's just come in. But with AVCO, AVCO, you take an average of all of the inventory that you've actually got. So not surprisingly, AVCO is the most common accounting method for inventory, but some businesses will manipulate the numbers. They'll switch from FIFO to LIFO and vice versa to make their margins look stronger. It's really important that your CPA goes through this. It matters because especially when dealing with raw materials like oil, for example, costs can fluctuate constantly. Let's look at an example. Say you have a $100 product to sell to the customer, and the oldest ones in your warehouse cost you $57. The newest ones that you have in your warehouse cost you $63 because the price has gone up over time. Yet you're still charging the end user only $100. So the margins would look pretty different on each of those. If they were using the FIFO method at $57, the gross margin is 43%. Whereas using AVCO at $60, the gross margin is only 40%. I've seen instances where business owners, when they come to sell their business, flips their inventory method from LIFO to FIFO to give them a bump on that margin. And that margin bump, that drops straight to the bottom line. So as you're multiplying EBITDA to make an offer on the business, that can mean a lot more money to the seller. In addition to the different ways to record inventory, you also need a detailed analysis of the overall age of that inventory. Because if you're looking at a manufacturing business, clearly there's going to be stuff in that warehouse that's going to have been there for a while, some of which may be obsolete. You'll need an analysis of how old the material is, how many weeks of inventory cover does the business typically have on hand, is there any redundancy with the inventory, how fast does it move, and what are the return rates, etc. You might find that some inventory you can send back if it's not selling, or if there's inventory that's obsolete, you don't want to be paying for that. So those are typically write-offs that you can make as part of the deal negotiation and just get rid of them. Make sure your CPA goes through everything related to any physical inventory. When doing financial due diligence on expenses, your CPA will go through and look at any one-off costs in addition to the recurring costs. They'll look at what the business is spending on marketing, on sales development, and on events, etc., and how critical that is to continue. They'll look at what key suppliers are really important to this business, what suppliers that without them would cause the business to struggle to trade and operate. If the business is highly sensitive to one particular supplier, your CPA will look to reaffirm it's a solid supplier and or find an alternative source of product. After expenses, the next step in financial due diligence is to look at cash flow. So cash flow is really, really important. There's an old saying, revenue is vanity, profit insanity, but cash flow is reality. It's all about generating cash flow. So your CPA will go through the cash flow statements and cash flow forecasts, and they'll look at the timing of large payments. In the UK, for example, there's generally a VAT return, a tax return to the government every 90 days. So those are big, chunky elements of cash that go out of the business every quarter. And your CPA will go through and analyze the bank statements. You want at least 6 months of bank statements so that your CPA can reconcile the timing of revenues going in, expenses going out, and how they impact the cash balances of the business month to month. So say you've got a highly seasonal business that you sell, say, ice cream, for example. Obviously, in the summer months, business will be booming. Your cash flow is going to be very, very strong, and your cash balance and your net working capital is going to be really high. But in the winter months, when apart from restaurants, people aren't buying much ice cream. In those months, you might be losing money and your cash flow might be negative. However, because the summer months outweigh the winter months, it'll be a net positive over the course of the year. Your CPA will then go through the balance sheet in quite a lot of detail. They'll go through the fixed asset register. They'll look at what assets are included with the sale, how the assets depreciated and what their current value is. They'll look at the CapEx, what's been spent on new equipment historically, and what potential CapEx is stated in the budget to upgrade any of the equipment. That's cash that you're going to need out of the business to do that. Your CPA will also look for any big projects in the pipeline that will need a cash outlay to get them up and running. All of the contractual stuff in the balance sheet needs to be identified, such as future contracted commitments, payment plans with suppliers, things like that. Your CPA will do a detailed analysis of the receivables or trade debtors, as they're called in Europe. They'll look at the aging of those numbers. Those are really important if you're going to be using accounts receivables for financing. And they'll do the same thing with accounts payable. What you tend to find in a lot of businesses is that they pay their suppliers much faster than they're actually getting paid by their customers. And that's one of the things that you can flip very quickly once you buy a business. Your CPA will do some analysis on bad debt provision, meaning what customers haven't paid and what has to be written off. And if you recall, we talked about this a little bit in the valuation lesson. A lot of brokers will attempt to add those write-offs back to the balance sheet to create larger profits. But they can't do that because even with credit controls in place to minimize them, bad debt write-offs are unfortunately a cost of doing business. The CPA will also go through all of the liabilities in the business, especially if you're inheriting them. You'll need a breakdown of all the existing debts, so loans, overdrafts, leases, and equipment financing. They'll want to know what the terms are for the contracts for all those things. Then there's also going to be some due diligence around taxes, basically making sure that the business has paid all of the tax that it owes. Any government-related debts or tax, whether it's payroll tax, sales tax, corporation tax, that all needs to be analysed, both in terms of the amount and also the timing of the payments. And then things like prepayments, accruals, any advance payments that you've received for work that's not yet been delivered, or any deferred income or deferred expenses. So you've had the benefit of something, but not been charged for it yet. All that stuff needs to be clearly identified. And typically your CPA will go back 5 years just to make sure the tax returns have been done properly, that the taxes have been paid on time, and that there have been no issues. Any government correspondence that's ever been received regarding taxes, that is normally held on file, and you'll want copies of all that. If the business has gotten into trouble in the past, perhaps it's had to phase its tax payments with a payment plan, you'll want to know that. And the company will also have to disclose whether it's had any tax investigations. You want to be certain that the business, if it's been in trouble previously, has resolved its tax issues properly with the government. For some acquisitions, forecasting due diligence is very important. Now, some businesses don't forecast, unfortunately. They just trade year to year. They don't have a business plan or forecast for the growth of the business. If they do, obviously, you want to have your CPA understand what process that they used. Because there's typically two ways that you can forecast. You can do it top down. So if the business is growing, if the business is doing, say, $1 million, and you say, yeah, we want to grow it 50% this year, so it's $1.5 million, that's our forecast. Great. But then how do we get there? If you do a bottoms up, looking at individual products, so we can sell X number of this product and we can increase the price by, say, 5%, and we can do this and we can do that, and then it all builds from the bottom up and generates that top level number. You also want to know what assumptions have gone into the forecast. So if the business has forecasted it's going to grow 50% and go from $1 million to $1.5 million, why do they think that? What are they seeing? What are the trends? What are the drivers? Have they got a big pipeline of potential new contracts? Have you got insight as to when and how those deals are going to be closed? If the business has been forecasting for a while, you'll want to see what did the business actually generate compared to its forecast. So if the business forecasted to go from 1 to 1.5 million, but in actuality it only went from 1 to 1.2 million, it missed its forecast by $300,000. Why did they miss? What happened? So you want to understand all of that as well. As for the business's accounting process, your CPA will just want to understand who prepared the accounts. What's the system or the bookkeeping software used? Have there been any changes in accounting policy? Do they publish on a cash accounting basis versus an accruals accounting basis? Has anyone ever reviewed the accounts? Have they ever been audited? What are the checks and balances that they've actually been through? So that's the kind of financial due diligence you'll need to go through your CPA. The final and a critical component of financial due diligence is to take a look at net current assets. It's really important that this gets written into the LOI, the letter of intent. Net current assets represents the working capital that you want to see in the business at closing. And from my experience, this is one of the most hotly negotiated points of a deal when you're going through the LOI. You can agree to the terms of the deal, how much you're paying, what the valuation is, when are you paying, all that stuff. But then you get down to the working capital amount. There can often be a lot of arm twisting. As a reminder, net current assets are the current assets minus the current liabilities. And from our original deal example, we saw in 2019, the total current assets were just under 1.38 million, and the current liabilities were $294,000. So the net current assets were just under $1.1 million. But it's not enough just to know the annual number. You need to know what they are monthly. Really, really important. In December 2018, the NCA was $885,000, and then it spiked up to $1.1 million by the end of 2019. Clearly, this business has been growing, but you need to know how that number's flexed month to month during that year. So this business is a bit more seasonal in the later months of the year, the winter months. So the key question now is, what level of net current assets do you want to see it closing? Really, it needs to be as high as you can possibly negotiate. It's like buying a piggy bank off somebody. And obviously, the more money that's in the piggy bank, the day you buy it, the better off you're going to be. It's exactly the same when you're looking at net current assets on the balance sheet of a business. So for me, my opening negotiation would be, well, the maximum net current assets this business has had in its last few years is 1.1 million. That's what I want to see in the business. What the seller will come back and say is, well, actually, let's take the average. And if you take the average across all of those different data points, you'll see it's around $994,000. But the absolute minimum you want is 1.02 million. So that covers financial due diligence. Your lawyer will then get involved in the legal due diligence, which is much more important if you're buying the shares of the company rather than just the assets. It's really important to understand how the business was titled and incorporated. It includes due diligence around all the property and other assets. Does the business actually own them? Is it eligible to sell them free and clear of any debts or anything like that? You also want to get into contracts of employment for employees, including benefits or pensions, 401k, all those different things. And when the lawyer is going to go through and look at any claims, litigations, or disputes inside of the business, including active claims, passive claims that may not have come to the surface yet, or claims that have been resolved one way or the other. Your lawyer will also do due diligence around if there's any intellectual property and associated trademarks or patents, that kind of stuff. If the business has got any charges or liens or debentures or guarantees against any of its assets, if they borrowed money or if they have an overdraft, if it has any large material contracts like a rental agreement for the building that the business trades out of, or contracts with any major partners or suppliers. If any shareholders agreements or operating agreements, also known as articles of association and the memorandum of understanding documents in the UK, are all those available and in order? Are there any general insurance and product liability? I was part of a deal a number of years ago, and I talked about this on an earlier video. A marine safety device business. There was an issue with the product liability, which nearly killed the deal, but we got over that. If the business needs any permits or licenses or consents or compliance to actually trade, if the business has been involved in any bribery or corruption or any environmental issues of any kind, whether it's ever filed a Chapter 11 or Chapter 7, or in the UK has been through administration or liquidation or any other kinds of related party transactions, whether there's been any shareholder or director or member loans to from the business. Did the business struggle historically? So the owners had to put money in and that money is still owed to them. That needs to be understood. If the business had loads of cash and the owners didn't want to take it out as dividends and pay tax, if they borrowed the money from the business through a shareholder or a member loan, then do they need to put that money back into the business? And if there are any subsidiaries or branches or any kind of satellite offices or locations for this business, that all needs to be understood. And there are more things I can list here, but those are the biggest. Ask your lawyer for a list or rundown of everything they intend to dig into. And make sure in the end you get copies of any statutory documents, or the books as we call them, things like share certificates, membership registers, units, anything like that. Now, finally, there's commercial due diligence, where you're really checking the marketplace. Now, some of this stuff you can do yourself, get your team to do it, or hire a consultant. You're looking to understand what are the trends driving the business? What are the opportunities? What are the threats? And how is the business positioned relative to all of those market dynamics? Who is the competition? How do they beat the competition? How does the competition beat them? Are there any issues there? Details around market share. What's the market share of this business? Do you have any data from the seller? And you also want to dig in the business's reputation and standing. What's the general feeling of the business in the marketplace? And talk to some customers. What do they feel about this business? What does it do well? What does it not do so well? What can it improve upon? Clearly, you don't want to buy a business that's got a terrible or declining market reputation. You want to understand its marketing strategies. How does it win new business? How does it price its products and services? How are those prices compared to other people, competitors in the marketplace? Can you do any analysis of what's happened in this industry over the years and whether this business has kept up or it's fallen behind? Is it at the forefront to capitalize on what's happening, the cutting edge? Or then there's finally going to be some customer analysis, supplier analysis, any partners or service providers, some analysis around those. How is this business spending its money? With who? You want a nice, diverse, long tail of customers in the business. You can also look at the industry supply chain. Where does this business sit in the supply chain compared to where does your current business sit in the supply chain? You might be buying a business inside of the supply chain to capture more of the margin. And then much of this we've already covered, but the funder or financier will do their own version of everything we've just talked about. The primary focus is going to be on the financial due diligence because their financing is going to be secured against various assets. So you'll see a lot of work on profit margins, revenues, customer concentration, the quality of the assets, and the quality of the cash flows. And you and your CPA will likely manage all the flow of that information. And at the conclusion of due diligence process, the seller will fill out something called a letter of disclosure, which requires them to report anything and everything regarding the business. And a lot of this stuff, a lot of the information you'll see in the legal lesson next ties into the warranties and indemnities that they will give you upon sale. So they have to tell you everything that they know or should know with regards to the business, good or bad. And what happens once due diligence is done and you get the reports from your various advisors, if everything's good, that's great. You push on with the deal. If there are some small or medium-sized issues, you have grounds to potentially renegotiate some of the terms. For instance, if the assets aren't worth quite as much as reflected on the balance sheet, or revenues were slightly understated, or costs were slightly overstated, so margins were lower, those can result in small to medium price changes and changes in the deal structure. But major issues could be big deal breakers. You could find out in legal due diligence that the business is being massively sued by one of its clients or suppliers. The business could be under major tax investigations, or you find out that one customer that accounts for 80 or 90% of the revenues is in big trouble. Those would all be deal breakers in my book. Same with the suppliers. All the suppliers from one company and that company doesn't want to supply the business anymore or is about to go bankrupt. Again, that would put the business and the deal in jeopardy. Or you might find the business is doing unlicensed, illegal, or immoral practices, which could have massive negative implications. You want to make sure that's all covered off. So that's it for due diligence. Again, let the experts do this work for you. I know there's a lot in here that you've already forgotten, but remember, you hardly have to do any of this work. Your job is to manage the people that do and manage the flow of information. But I wanted you to understand what it's all about. So I'll see you soon on the next lesson, what to expect leading up to closing day. Until then, bye for now.